Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Thursday, December 29th, and then see how things look for Friday, December 30th. We had a pretty solid up day. Unfortunately, we've just done enough to work off the short-term oversold condition, most of it, and we've just been able to climb back up to the upper side of this range that we've been in. So nothing has really been decided at this point. We want to see now, can we continue to have this Santa Claus rally, or are we just going to fall back down within the range that we've been in for the last week or so? That's kind of where we're at right now. We're still negative overall. All of our indicators are pretty much pointing down. But if we see some follow through action to the upside, that might change the picture. Unfortunately, we just have to go with what we see right now and then just guess as to what might happen going forward from here. So let's go back and discuss some of the things that are happening. First of all, please be reminded that on January 7th, there is a free webinar that you can attend. I'm not connected to this in any way. I'll just be participating in this as well. I have no connection to this company, but it's somebody that I watch some of their videos, not all of them, but some of them, and they have some useful insight into the market, and they're putting out this free webinar on January 7th at 9 a.m. Eastern time. All you have to do is provide your name and email address, and you're signed up. I've already signed up, so I just wanted to make that aware to you. All right, so let's go back and talk about what happened. We did have a gap higher open. The futures were pretty strong going throughout the night, and as we got closer to the open, they became stronger and stronger. That produced the gap higher open, and we were above the daily pivot at 3904. So we regained that 3900 level, and then we were able to stay above that. So we're back within the range that we've been in already, and we were able to go up to R1 at 3827. And then we topped out a bit at yesterday's high. As the day went on, prices then stayed above yesterday's high. Going into the close, we closed almost at the high. We were up 1.75%. Volume continues to be below average as the markets are in holiday mode. The technicals, as I said, they're still negative overall. We're working off some of the short-term oversold condition, and we're just at the upper part of this range that we've been in. Inflation and interest rates are still the real fixation, which are also producing growth concerns. That's what the market is really worried about right now. So here's the intraday chart where we gapped higher above the pivot. We quickly shot up through R1. We went all the way up. You can see here's yesterday's high, which acted as resistance for a little while, but then we broke above that. And then we stayed above yesterday's high going for the rest of the day, closing a little bit off of the high. Please also be reminded that every day I update a daily chart and a intraday chart showing you the pivot points for the next day and then for the month as they occur. And they're in the community tab on the YouTube channel. All right, so what are some comments? Again, we're in that period right now where people are looking for the Santa Claus rally, and that's the last 5 trading days of the year and the first 2 trading days of the new year. So we're right in that currently. Also, I've put this up before, but just be aware of this. China will end quarantine requirements for international travelers on January 8th. Also, they're lessening a lot of the restrictions for the Chinese people. And even though that's leading to a lot more sickness, the folks are having a chance to move around a little more than they were before. The S&P did regain the 3,800 level, but is still under that 3,850 level. We're kind of in that range right now. The VIX is still acting kind of strange, as is the equity put call ratio, and I'll show you a chart of that. The concern right now is earnings per share for each individual company, and then the valuation of the Dow, of the NASDAQ, of the S&P 500. Stocks are still considered to be expensive, and as earnings estimates come down, that's making the market more expensive, which does have some pressure on stock prices going forward. The US dollar declined and interest rates were down, so this gave some positive backdrop to stocks. Usually when the dollar declines, that helps stocks, and when interest rates go down, that also helps stocks. On a short-term basis, our PMO studies, we still have a few areas that are extreme negative, as well as our stochastics, and I have charts of both of those to show you. But the other ones, the Williams percent R, the Stoch RSI, they've worked off their short-term extreme negative reading. And in yesterday's video, I pointed out that the 30 to the 5-year yield had gone back to being more normal. Well, it switched back to being inverted. Sentiment is still in the fear area, so we go with that. We're not really getting an extreme fear reading at this point, according to this one gauge that we use, so that is more negative. The weekly jobless claims came out at 225,000. That was more than the 220,000 expected and more than last time when we had 216,000. We're watching this employment situation right now because that's what the Fed has been using to justify raising interest rates and having this more hawkish environment because the employment situation is holding up. So we're keeping an eye on this to see, is there weakness in the overall employment situation? Our trend is still negative, and it is strengthening. The ADX is just slightly above the moving average. We're still below 20, though, so that would suggest a trendless environment, which is pretty much what we've been seeing lately. Our bias, I've switched back over to positive because of the update, but I've kept our momentum at mixed for right now. You can't quite see that, but it's at mixed. We've had some down days, some up days. We're not really going anywhere overall. It's like we're on a treadmill right now as far as price is concerned. So I've kept our momentum at mixed. Here is an updated chart. I finally found one of these just showing the yellow line here is going back to 2006 through 2008 and how the white line, which is right now with the S&P, how the two have been going in pretty strong correlation with each other. And if that continues, it would suggest that we will see more weakness in the S&P 500 going forward. This seems to be breaking down, and this is also an updated chart. We're not really following this. Even though we're going down with the S&P, we're not going up with the VIX. That's why I say it's really acting strange. We would generally see a lot higher readings than this currently, but we're just not seeing that. Here's the VIX to S&P 500 correlation, where this continues to go up. And this is another kind of strange thing that happens from time to time. And when we continue to go up and eventually hit a spike and then start to come down, if you look down at the bottom, you'll see a lot of times that marked a short to intermediate term decline in the S&P 500. So that's why we're keeping an eye on this. But we don't really have a signal as of yet. We did get the weekly Association of Individual Investors, the American Association, and they're still extreme negative. And so we tend to use this as a contrary indicator. However, we're not really at a point right now where the market has washed out as far as price. We were up 1.75% on Thursday. And now this is a few days old because this is a weekly survey that they come out with. But generally, when individual investors are extreme negative and we're seeing a lot of capitulation and price action, that's when the signal seems to be more valid. And we're not. We're just trending around sideways for the most part. Even though folks are negative, we're not really seeing any kind of critical mass at this point. Now, that could change at any time, but right now, we're just not seeing that. The Ulcer Index, which attempts to measure fear in the market, as this goes up, that means there's more and more fear. It continues to advance even with the up day. And you can see I'm circling the range that we've been in, where yesterday we were down at the bottom of this range. Well, with Thursday's advance, we've now come back to the top of this range. And here's the equity put call ratio after giving us just this monster daily spike. Yesterday, it has come down, but it's still really high overall. And then we look at the 5 period where now we're going to see, is there some kind of a spike here that we can work off of? But again, we're not really seeing that in price action. A lot of folks, when this goes up, that just means folks are hedging more. They're buying more puts than calls to either protect a position or take advantage of downward movement. And with us going sideways and getting such a high reading, it's really hard to take this really serious for right now. But you have a lot of folks that are very nervous about what's going on. 2022 has been really difficult. And just about the time when it looks like we're going to shoot up, something happens and all of that falls apart. And with the holidays and people taking vacations, it's not surprising that they're doing a lot more hedging. And then this is a longer term version of that chart. After getting really high up, we're coming down, but we're still at a really high level currently. And then after Wednesday's session, it looked like, okay, I have to get back to the right chart. It looked like we had gone down extreme negative, a little too far, too fast. Well, in Thursday's session, we've gone up a little too far, too fast on the advanced decline ratio. So we may have overdone that. As far as our trend, the ADX is still just a little bit above the moving average. We have to default to the negative because the red line's on top, even though it is declining. And we see where buying power is also continuing to decline, and we're below 20 with the ADX. So this is a trendless environment, according to this indicator. Haven't shown this in a couple of days. Our double and triple exponential moving averages. The reason I bring this up is we're coming right back up to the underside of this anchored moving average going back to the COVID low. This could end up providing some overhead resistance. We're just a little bit below it currently. The BPI, it didn't really shoot up with prices, but when we're going sideways, it's not generating a lot of new buy signals with the point and figure charts. So this is a little bit of a negative divergence where we saw a pretty solid update, but the BPI didn't go up, but it did advance overall. What we're looking at more is when we have this kind of toppy looking pattern and then we start to decline, a lot of times that will mark a top in the S&P, but we're not really seeing a blow off top. Earlier in the year, back in August, where we went up and then came right back down, that's kind of like a short-term or intermediate-term blow-off top. The same thing happened last spring, where we just shot up, hit overhead resistance, and then came down. The BPI was extreme positive and then came down both these other times. Well, we didn't really see that. We're seeing more like a head and shoulders top right here, which also could be a negative signal. But this really hasn't worked itself out yet as long as we stay in this sideways range. Here's our PMO studies where we worked off this extreme negative reading with the PMOs that were rising. We're still extreme negative with the buy signals, and we continue to decline with those PMOs that are above zero. So this has worked itself off, but we're still extreme negative with the buy signals. Stochastics worked off the short term. We're still looking extreme negative with the intermediate term, and the long term, even though it's turning back up, is still extreme negative. So that's why we're not quite out of the oversold condition, at least yet. And if we have a declining day on Friday, we could go right back into that very easily. The daily chart is just showing how we had been down below the pivot point. Well, with Thursday's advance, we were able to get back above that, but we're still below the 50 and 200 period moving averages. But we did regain this pivot level, so that's positive. And then at the bottom, you can see where volume was up. It was about the same as Wednesday, but it's still well below average. We're still below all of the moving averages in our moving average tree. If we do try to break out to the upside, some of these levels may act as overhead resistance. And one thing I wanted to point out is the summation index, which is, again, a trend measuring tool. It's still declining based on price, but it's turned up slightly based on volume. Sometimes this is a leading indicator for us. Not always. Sometimes it's a fake out, but with the upward movement on Thursday, having the volume turn up is positive. And if we see follow through price action, the price part of this indicator will likely turn up as well. New highs, new lows, saw a little bit of a breakout with the new highs and not really much with the new lows. So we're still continuing to decline in our 5 period and in our 10 period. So internally, we're not seeing a lot of strength yet. And that kind of makes sense. We've been chopping sideways Stocks that already registered a new high, well, we're just getting back to those levels. And until we can really break out to the upside, we're not going to see real improvement. Or if we really break down out of this range, we'll see a real advance of new lows. Our Elder Impulse, after switching over to negative, has now switched back to neutral. And the Swinland Trading Oscillator, based on price and volume, we did decline a little bit, even with the up day, based on price, and we're pretty much flat to slightly higher based on volume. And sometimes this ends up being a leading indicator. Unfortunately, we're seeing a real mix with price and volume giving us slightly different readings right now. So we'll just want to keep an eye on that. Mostly what I looked at when I saw this chart is on an up day, the STO declined. So that's a little bit of a warning sign. Our Ichimoku cloud, after getting down to the lower end of support, we've been able to bounce back up above that. So support is still holding with this indicator. With our short-term fib levels, we were down below this double fib retracement level. Well, we were able to regain that on Thursday. Longer term, kind of the same thing. We were down below this double fib retracement level. And with the advance, we're now slightly above that level. Weekly, again, kind of the same thing. We broke down below this 38.2% retracement level, and we were able to recapture that. And we're down just a little bit below the midpoint with our trend channel. And then one thing I wanted to point out is the mid caps. They're getting ready to give us a golden cross. So that could be positive. And it's been quite a while since we've seen any kind of a positive move. We saw one with the Dow, which is the next chart. We're still working off a golden cross here, but with the mid caps, that could end up being positive. But we're not really seeing that with the S&P. We're not seeing that with small caps. We just want to be aware of this and just keep it on the back burner. And as I said before, the Dow is still hanging out above the moving averages. So this golden cross, even though we're chopping sideways, it still looks like a valid signal. So what's our outlook then for Friday? Technicals are negative, and we have to ask this question. Can this Santa Claus rally, can it continue? We saw a good upward day on Thursday. Will that carry over into Friday, or are we going to go back down into that range? We just have the Chicago Purchasing Managers Index coming out in Friday's session, and then the whole list of geopolitical events. One thing that I did add to this list where I'm circling with my pointer is deflation. I'm starting to hear a little bit more talk about that. I won't really go into detail of what that means, but it's quite negative. And that's what we saw back in the Great Depression. Not we, because that was a long time ago for us. But if we head into a deflation environment, which may sound really cool with prices going down, but it's very devastating to the economy. But I'm hearing more and more folks talk about that. And because prices are coming down from being really high, not only does it appear that inflation is starting to taper off, but prices are starting to drop overall, and that could lead to a deflationary environment. So we just want to be aware of that. Our scenarios can't really go with the down one here because we're just kind of chopping around, even though everything is still pointing down technically. We're at the top of the range. So what we want to do is, are we going to break out to the upside, or are we going to break down to the downside? Can't really go with the up scenario because all of our charts are looking negative. Our scenarios, rotation, and setups, yeah, they showed some improvement on Thursday, but we're not really working off of solid signals as far as those are concerned. And that's why I'm not showing any charts, because there's really not a lot of change in them. Our technicals are still negative. We're still below, with the S&P anyway, below moving averages, but we're trying to regain some pivot levels and some fib retracement levels. So we're going still with the sideways scenario because the ADX, even though it's strengthening, it's slightly above the moving average. We're still below 20. The red line's on top, so it is negative. So our conclusion, the S&P is negative and at the top of this recent range that we've been in. Short-term negative and slightly oversold. Some of our PMO studies, some of the stochastics are still extreme negative. Intermediate term, we're just flat out negative. We're not getting any extreme readings at all, and all of them are pointed down. Long term, we're still negative because we are below the 200-day simple moving average. So thank you. Have a wonderful day on Friday. I will prepare a video over the weekend. And please be reminded that the markets will be closed on Monday in observance of New Year's Day. So we get another 4-day trading week. So I will talk to you in the next video.